So I'm changing the format of what I'm doing, and if you watch the other video, you see that I've split the video that was longer, and I've now broken it into two parts, and this is the second part of that, what I normally do. So I'll be covering the dashboard of basically the direction of the stock market, charts, and data related to the stock market and bond market. We'll begin with the dashboard on the major stock market indexes. This is as of Friday, October 28th. A couple of weeks ago, 2 or 3 weeks ago, this was all red dots. And so today, the market has been moving up for the last couple of weeks, and some of these, the data is starting to show positive. And so in our 7 indexes, we can see what's going on. The Dow has been the strongest. The Dow has actually got 4 dots. It is above its 20, 50, 100, and 200-day moving averages. The small cap, Russell 2000, is above the 20, 50, and 100-day moving average, and the S&P above the 20 and 50. Foreign markets, developed markets, above 2 of them, the first 2. NASDAQ 100 is the weakest major index in the U.S., and it is only above its 20-day moving average and still below its 50, 100, and 200-day moving averages. Emerging markets, weak, still below all 4 moving averages. And bonds, definitely weak. Bonds are down 34% for the year. 34%. They were supposed to go up when the market went down. That didn't work. And they have not recovered. So what got people into this mess is probably not what's going to take them out of this mess. That is usually the case. So the Dow was down 9%, Russell 2000 down 17, S&P down 18, etc. So all the way down on the equity indexes, all the way down to the emerging markets, which are down almost 30%. This takes the S&P 500 and breaks apart the individual indexes within, or the individual sectors within the S&P, so that you can see where they are, the percentage gain or loss for the year, quarter, month, etc., and where they are relative to their 20, 50, 100, and 200-day moving averages. And you can see that every one of them, every sector, is above its 20-day moving average. That's a sign of strength, and it's a sign of breadth. Only 2 of them, and that's real estate and consumer discretionary, only 2 of them are below or only above the 20-day and are above, and then below all the other moving averages. So most of them are above 3 moving averages. And energy is by far the strongest, and it's above all 4. Okay, the S&P 500, this is a chart of the S&P 500, a weekly chart showing 1 move equals 1 week, and for the past year. You can see my black arrow shows the trajectory of the S&P 500 for the past year, generally speaking, is down. I put a circle at the end of this to show the last couple of weeks movement. It's a very strong move up. Is it going to continue? We don't know. It might. But if it does, my guess is that it's not going to last long, because we are still in a bear market, and moves up from here are very hard because of the headwinds that are in the economy right now. When I develop a ratio between the growth component of the S&P 500 and the value component, growth being the numerator, value being the denominator, And if it goes down, this shows that value is in favor. And if it goes up, it shows that growth is in favor. And that over the past 12 months, most of this time, the general trajectory is down, which shows that value stocks, those that are more dividend oriented, and I'll call them old economy type stocks, are in favor. And the growth stocks that were in favor in 2020 and 2021 are not. They're just not doing well, and they're not even recovering at this point. This is also a relative strength chart showing the direction of the Russell 2000 small cap index numerator and the S&P 500 large caps denominator. So if it's going up, that favors small caps, and if it's going down, that favors large caps. So you can see during the early part of this chart, this is a 24-month chart, during the early part, this would be about 5 months, the first 5 months of this 24-month period, small cap was tremendously in favor, and then it went out of favor, and then the large caps, S&P 500, became more, they both went down. The S&P 500 just went down less than the Russell 2000. Then it kind of hits the bottom down there on the far right, and I put an arrow there to just show that there is strength right now in the small caps starting to emerge and starting to be a little stronger than the S&P 500 or large caps. When I do the long-term government bond, I push this out over 30 months to show a longer-term picture. You can see that there are 2 moves down, and they are, this last year, actually almost a full year, back to November, beginning of December of last year, you can see that the long-term government bond has been going down and down and down. And this is significant because traditional financial advisors use this as a cornerstone in investment portfolios or something like it, some combination of bonds, but the 20-year long-term government bond is one of them. And its bonds are just decimating portfolios. And I think one of the lines that traditional financial advisors use is, we didn't see this coming. Well, I don't accept that at all, because it was clearly visible this was going to happen, because interest rates were at 0, had nowhere to go but up, and bond yields follow interest rates, which means that bond prices fall. It was, if you could see anything, you could see that this was coming. Okay, this is the short term, the intermediate term government bond ETF, IEF is the symbol, and same trajectory, down and down, and going down at about approximately the same rate. The short term government bond, this is the 1 to 3 year government bond, and it has gone down a lot. So you can see this goes back into late 2021. So for about a year, going down because interest rates and bond yields have been going up. Gold continues to slide and is down, and over the past couple of years. But this is a 48-month weekly chart. And the one thing I'll comment on here is that gold is down, but it's only down in the U.S., or it's primarily down in the U.S. Many countries, especially like in China, Russia, India, the gold is actually up. And the reason is our currency, because our currency is so strong relative to the currency. Gold looks like it's going down, but their currencies are weaker, which means they're actually seeing gold rise to new heights. So it has a lot to do with currency. Silver, same thing, even more so. When silver goes up, it goes up very rapidly. when it falls, it probably falls further down than gold. It's just more volatile. The relationship between gold and silver, again, over a 48-month period, silver, you can see it's starting to show some strength at the end of this period, but the general long-term trajectory, the ratio is favoring gold over silver. The volatility index for the last 12 months, the VIX, VIX, is up and down a lot. But I wanted to show just the trajectory. The trajectory is down, and what that means is volatility is coming out of the market. And that's represented by the trend down, the red line going down at the far right of the chart. I put my bar at the end at 24, which is an arbitrary number, and that's where it's generally thought that below that risk is volatility / risk has diminished quite a bit from the market, and but it's still above that, even though it's moving down. Asbury Research does their metrics. This is called the Asbury 6, and all of their metrics are now positive. And the last one that went in was the trading volume, returned positive on Friday, and the rest of them have been positive. So a good indication of strength, and the short-term trajectory of the market, at least for now, is up. This is a cross-asset relative performance chart, comparing assets one to another, which one is stronger, and it's represented by ETFs in the second column. But you can see that stocks are favored over bonds, small cap is favored over large cap, the Dow is favored over the S&P 500, and the S&P 500 is definitely favored over the NASDAQ. We showed you that earlier. Value is favored over growth. We covered that also. And the U.S. is favored over foreign markets, both developed and emerging. And you saw that also in the previous dashboard. In the fixed income, in the bond area, high yield is favored over corporate bonds that are high quality bonds. And the U.S. versus the world, if there's enough strength in the over the last week, the last month, the last quarter, or the last three sets of columns, the U.S. would get a green box. However, if these countries are stronger than the U.S., they would get a green box. So there are slightly favored more, and that means it's not a green box, or much more favored. And so you can see that only the countries of Italy and Spain, their ETFs, are stronger than the U.S. Would you have picked that? I don't think I would have picked that. But the U.S. is starting to show up more. It's just not showing enough strength to even merit a green box. Gold and silver, we've covered this earlier, but I'll explain it here. Gold is down slightly, 0.6% from a week ago. This is measured from Friday to Friday. And silver is down 0.5% over the previous week. I saw this on the Bloomberg news article. During this past 13 months, Mr. Zuckerberg has lost $100 billion of his wealth based on the decline in price of Meta stock. This last week, he lost $11 billion. Now, I don't expect you to be crying for him because he still has $38 billion left. But if he's lost $100 billion, that tells you he had about $138 billion 13 months ago. And even though he's not poor at $38 billion by any means, I don't know what his thoughts are about losing that amount of money in that period of time. Of all of the large cap tech companies, Facebook / Meta has lost the most. Thank you for watching. If you have comments or questions, leave them in the comment section and I'll answer them. Thank you for watching.